Hi, I'm Alex Sampson with Health Benefits Associates here in Reno. I'm going to make this short video just to explain some of the details of the Aetna Funding Advantage plan. I've been getting a lot of questions about it, and I'm going to answer some of those questions in this video, but obviously this is not going to be a comprehensive list of everything. So I'm going to put my contact information here on screen. If you have any questions, please feel free to reach out. I can answer any questions you have about the video. Also, just as a little disclaimer, please don't rely on this to go get medical services done or anything like that. We definitely want to make sure that the case is issued, fully in place, and you have all the details about which doctor's list to go to and how to use the benefits before going forward with it, obviously. So here, I'm going to explain some of the pros and cons. Let's start with the Aetna Funding Advantage, what it is. So Aetna came out with this product about 6 years ago nationally, 4 years ago here in Nevada. It's basically a large group plan that's available to small employers. So by that, they avoid a lot of the state mandates and state taxes. By doing that, they're allowed to offer lower premiums for their plans. So a lot of employers are finding this way more affordable than the traditional small employer health insurance plans that are out there. Also, these plans are based on health history, so they use something called GRX. GRX is a way to look up how much employees are using the pharmacy benefits, and then Aetna uses that to determine how much they're going to use the medical plan. By seeing that, Aetna does this anonymously. They're able to rate the group and put a number to how much they think the group is going to be using the plan, and the lower premiums are based off that number. So some employers will not be a good fit. Some employers use the plan quite a bit, and Aetna will rate them up because they do that. Other employers, they don't use the plan very often. Aetna will see that and give them a favorable rate. After the first year, we're usually seeing rate increases right around 8%, and that's just an estimate. 8% is trend here in Northern Nevada, and usually by the end of the first year, they don't really have enough data to base it off of prior claims. And so what they're going to do instead would be to just give that 8% increase after the first year, and then by the end of the second year, they can see how much the employees are going into the doctor and using the benefits, and that allows them to give a rate, whether it's an increase or a slight increase. Usually it's always, unfortunately, an increase, but a slight increase or a major increase can be based off that. Now what exactly is level funded? So I have this brochure here from Aetna. It explains some of the details of what level funded is. Level funded is a form of self-funded health plans, but before you turn this video off hearing that it's a self-funded health plan, just wait just a minute, because it's not like any other self-funded health plan that we've seen before. So what Aetna is doing with this, it's very important here. I think this sentence kind of explains a little bit of it. If medical costs are higher than anticipated, you're protected with stop-loss insurance. And so this is not a stop-loss limit like most people think, where it's some astronomical amount. And so Aetna is fully funding the amount that they expect in claims for that year, and the administration of the plan, and the cost of the stop-loss insurance. All of that's bundled into the monthly cost that the employees receive. So the employer, to be very clear, is not coming out with a check that they need to cut for any employees that have a one-time big charge. So if an employee comes out and you're paying for some kind of cancer treatment or something like that, Aetna is picking this up through the amount they've already collected and through their stop loss. So the employer is not like most self-funded plans where the employer needs to come out with that. So that's probably the biggest difference here. Another thing, the traditional funding versus self-funding. Traditional funding has a lot of requirements and hoops to jump through. Most of this is behind the scenes. The insurance company is doing this for you. With the self-funding, you're really seeing savings by not having to pay those state mandated taxes and fees. You also have the opportunity to get back money, and I'll go through that in just a minute here. The financial protection is always there, and from the outside for employers, I can't stress it enough, this looks just like a fully insured health plan. So you're not seeing that monthly cost go up and down based on if the employee is using the plan or not. The only way it goes up and down is if employees add or remove dependents. Now, you also get more flexible benefit designs, and they have a lot of benefit designs that are out there, and it'll be exhausting to go through them all in this short video, but I would say that they're very comprehensive. Now, finally, that claims reserve that we talked about, that possible getting money back at the end of the year that we talked about. So what happens is, if you have a pretty good year, and let's say Aetna collected much more than they needed to, employees didn't use the plan that much, there will be a reserve at the end of the year, a surplus. And so what happens with that surplus is Aetna will provide back to the employer 50% of whatever that surplus is. And they take 50% themselves. If there is no surplus, let's say you used up all of the insurance, at the end of the year, there's no check to cut to Aetna. They usually will probably come out with a rate increase that won't be favorable, but you can always switch insurance companies at that time. So it's really a win-win for the employer with regard to, you have the potential to either get money back, or if you used more than you funded, then Aetna has to absorb that. So let's look at the better coverage. So Aetna is offering some huge benefits, and this is why I have a lot of people right now looking at Aetna plans, because Aetna is one of the only insurance companies to cover as many hospitals as they do. Here in Northern Nevada, they cover all of the hospitals, major hospital facilities in town, and they have a very large list of doctors. I wouldn't say they cover all the doctors, because there will always be a doctor that won't work with insurance, and so that's always going to be out there. But as far as the hospitals go, they're one of the last out here that still cover all of the hospitals in town. United Healthcare recently broke away and does not cover Renown anymore. And so I have a lot of people that were on a United Healthcare plan because they covered Renown, and now they switched over to Aetna. They not only are seeing lower rates, but they're seeing their doctors are covered again. So that's very important. Aetna has 2 doctors lists that they use. One of them is more affordable, and it does not allow out-of-network coverage. The other is more expensive, and it does allow that out-of-network coverage. You can also mix and match. So if you wanted a base plan that was that more affordable type, and then let's say a couple buy-up options that had a bigger doctor's list, that's great. Now, let's talk about how to get it. So that might be the benefits of the plan I kind of just went over. And now let's talk about the underwriting process. So as with any health insurance plan, underwriting is more difficult. Once the plan is issued, then adding and removing employees is fairly easy. So the group size. So here, Aetna is working with groups with at least 10 employees. Now there's one category from 10 to 24 employees, and Aetna right now, this is the end of June 2021 through October 1st effective dates. Aetna is not requiring these groups to provide health statements. Now normally they would. Instead, they're going to just use that GRX rating now through October 1st. For groups with 25 or more employees, they are always going to use the GRX rating, so they're just going to need those employees' home zip codes, full names, and dates of birth of everybody enrolling. And so that's very important. If your group has more than 50 employees, they're going to need some other additional information, because at that point, over 50 in Nevada is a large group, and they'll need some more details regarding any kind of claims history reports you have, or plan designs and things like that. Now the group cannot have less than 50% of their eligible employees enroll. Now eligible employees are employees that are not covered through their spouse's coverage, or through the VA, or through Medicare. These are all not counted against you. And so what they're really saying here is 50% of the employees can't just waive the coverage without any other qualified health insurance. And so that's a pretty low bar to hit overall. I think most groups that we work with, most insurance companies we work with require at least 75% participation, meaning no more than 25% of the employees can go uninsured. And so this is something that we work with you on, and so don't sweat the small stuff. We definitely want to work with you. If you don't think you have 50%, come talk with us again. Now, other important information about the plan. Aetna will re-rate your group if you have more than a 20% change from what was quoted to what you actually enrolled. And so they don't want to see more than 20% of the employees be added or removed when it comes to the final enrollment versus the quote. Also, any additional employees that decide to enroll last minute will have to pass health questions. And so if they get the quote and they rate the group based on that GRX data, again, the pharmacy utilization, and then give you a rate, and then let's say a lot of employees that use the plan more often see that rate and say, you know what, I want that plan, they are going to need to pass health questions in order to do that. And employees that are added after the plan is issued, let's say new hires that are added later, they will not have to pass health questions. And so they will simply get the rate, whatever rates that are guaranteed for your group upon issuance. Those rates are set for the year. So that's going to be for a 12-month period. So I'm going to put my contact information up just one more time. I'm Alex Sampson with Health Benefits Associates. Again, I did not go over all of the details of the Aetna Funding Advantage plan, but I would like to with you. Please give me a call or give another representative in our office a call. I work here with 7 other brokers, and we would be glad to answer any questions you have about these plans. We've issued these plans to several of our groups, and more increasingly now that United Healthcare is not covering Renown. And so if that's a possibility for you, we'd love to get you a quote and get this issued for you. All right, thank you so much for watching.